The impact of the Troubled Asset Relief Program, TARP, on derivatives, presented by SethBall. The 2008 financial crisis, severe worldwide economic crisis, as also known as the Great Recession, was the most serious financial crisis since the Great Depression of 1929. The factors contributing to the crisis were predatory lending targeting low-income homebuyers, excessive risk-taking by global financial institutions, and bursting of the United States housing bubble. The impact of the crisis, it created a perfect storm scenario, leading to the collapse of mortgage-backed securities tied to the American real estate. A vast financial product and asset collapsed in value, and worldwide damage to financial institutions, all climaxed with the bankruptcy of the Lehman Brothers on September 15, 2008. Subsequent international banking crises followed, and the housing prices dropped more than during the Great Depression. The introduction of TARP was authorized by the U.S. Department of Treasury to purchase or insure up to $700 billion worth of troubled assets. The residential or commercial mortgages related to securities issued before March 14th of 2008, designed to promote stability by purchasing and guaranteeing the troubled assets. The objective: improve liquidity of troubled assets, reduce potential losses for institutions owning these assets, and the limitations were did not allow banks to recoup losses already incurred on the troubled assets, and the anticipated stabilization increase in the value of assets once trading resumed. Now on to TARP's impact on finance. TARP's intervention helped mitigate systemic risk by providing the much needed liquidity to the financial institutions. This liquidity injection prevented a potential domino effect, where the failure of one institution could trigger a chain reaction of collapses across the financial system. The stabilization of financial institutions through TARP contributed to preserving jobs and economic activity. A collapse of major financial institutions could have had severe consequences for the employment and economic growth. As TARP addressed the immediate threat of the insolvency faced by several key financial institutions, by providing a capital injections, the program aimed to shore up the balance sheets and prevent the failure of institutions that were deemed essential to the functioning of the financial systems. As continued from the impact of finance, TARP's impact on the financial industry also has long-term consequences. The program's intervention, while preventing a catastrophic immediate collapse, raised concerns about the moral hazards. Institutions deemed too big to fail received implicit guarantees, potentially distorting the market incentives and creating risk for future crises. TARP's implementation influenced subsequent regulatory responses and discussions about the financial reform. It contributed to the debates on the appropriate role of government interventions in times of financial distress and the need for regulatory safeguards. TARP's impact on the derivatives market. TARP's intervention in the financial market influenced the perception of risk within the derivatives industry. The program addressed immediate risk associated with the troubled assets, impacting how market participants assessed and managed risk. The ejection of the capital, the purchase of assets, and the overall stabilization of the financial institutions influenced the valuation of related derivatives instruments. Implicit guarantees associated with TARP potentially could distort incentives and risk-taking behavior within the derivatives industry. Institutions may have been inclined to take on more risk given the belief that the government could step in and prevent their failures. Continuing on derivatives and the impact TARP had, TARP's broader impact on stabilizing the financial system contributed to the mitigation of systemic risk within the derivatives industry. TARP's role in the financial crises and subsequent regulatory responses influenced the discussions about derivative regulations. The program contributed to debates on the need for regulatory safeguards, oversight, and the appropriate role of the government in mitigating the risks associated within derivative markets. TARP's influence on risk perception and the overall financial landscape contributed to changes in risk management practices within the derivatives industry. Institutions have adjusted their risk models and strategies in response to lessons learned from the financial crises. The ones who were too big to fail. The adjustments to the regulatory framework, including the Dodd-Frank financial reform legislation, did not address the core problems that led to the 2008 crisis. As powerful individuals in the financial system still have the incentive and ability to take on large amounts of reckless risk, particularly through leveraging. The six largest banks holding companies have assets valued at just over 63% of the GDP, up from 55% before the crisis. These large institutions perceived as too big to fail, enjoying implicit backing by the full faith and credit of the US government. The perception of being too big to fail allows these institutions to borrow more cheaply than can the competitors, facilitating further global expansion. These large banks discuss plans for global expansion while maintaining high levels of leverage. This poses as risks to financial stability. Now, learning from the past, studying the effects of TARP and the similar programs provides valuable insight into how interventions influence derivative markets. Future policies should aim to mitigate this risk, possibly through stricter regulations for larger financial institutions or provide mechanisms for safe wind downs. TARP highlighted the need for a greater transparency and oversight in derivative markets. Future policies could focus on improving the reporting standards, enhancing clearinghouse roles, and promoting exchange-traded derivatives for transparency. Derivative markets are global, and regulatory policies in one country can impact others. Future policies should consider the global context, and the international cooperation in regulatory matters should be a priority. My closing thoughts: Troubled Asset Relief Program, also known as TARP, stands as a pivotal initiative undertaken by the US government to counteract the devastating impacts of the 2008 global economic crisis. While TARP achieved its immediate goal of stabilizing the financial institutions, its legacy is multifaceted and subjected to ongoing debates. The program's mechanisms, such as purchase or insurance of troubled assets, aim to enhance the liquidity boost consumer confidence, and prevent collapse of financial institutions. Scrutiny still surrounds TARP's perceived bias towards benefiting the large corporations over the consumers, and its potential role in incentivizing risky behavior within the financial sector. Furthermore, researchers may investigate alternative strategies for managing the financial crisis, while aiming to strike a balance between immediate stability and addressing the criticisms leveled at TARP. The evolution of financial policy and the crisis management remains a dynamic field, offering ample opportunities for insightful inquiries and innovative solutions.